Okay, if you're running a small business in Canada, you already know that growth needs fuel. And that fuel, capital, is often the hardest thing to find. So today, we're going to demystify it all. We'll break down exactly how you can fund your growth, from tapping into government-backed loans to making really smart choices about equipment financing. Yeah, this quote probably hits pretty close to home, right? You've got the vision, you've got the drive, but getting the actual cash to make it all happen can feel like you're just running into a brick wall. Well, let's talk about how to start knocking that wall down.
So why is it so tough in the first place? Well, the simple truth is, traditional lenders, banks, they don't love risk. When they see a startup or a small business without a ton of assets, they get nervous. And that hesitation creates this huge funding gap that can stop even the best ideas dead in their tracks.
But there is a way to bridge that gap. It's a bit of a secret handshake, and it's called the Canada Small Business Financing Program, or CSBFB for short. Think of it like this. The government steps in and gives your bank a reassuring nod, which makes them way more comfortable saying yes to a business just like yours.
Now, let's just bust the biggest myth about this program right now. This is not a grant. It's not free money. What it is a loan guarantee. Essentially, the government pulls the bank manager aside and says, hey, if this business can't pay back the loan for some reason, don't worry, we'll cover up to 85% of your loss. That massively lowers the bank's risk, and that in turn skyrockets your chances of getting approved.
And we are not talking about small potatoes here. A single business can get its hands on up to $1.15 million through this program. That is serious capital, enough to fund some major growth, whether you're buying property, new gear, or just need working capital to keep the lights on.
The program is also super flexible with how you use the money. You can get a term loan of up to $1 million for those big ticket items. And within that, there are sublimits for things like equipment or working capital. But wait, there's more. On top of all that, you can get a separate line of credit for up to $150,000 just to manage all your day-to-day costs.
Okay, now listen up because this is the part that so many people miss, and it is an absolute game changer. It's called the 365-day rule. It means you can use a CSBFP loan to pay yourself back for eligible stuff like equipment or renovations that you already bought and paid for in the last year. It is a crazy powerful way to inject a shot of cash right back into your business. So who is this program really for? Well, the numbers couldn't be clearer. Almost 3/4, 74% of all these loans go to startups, businesses that are less than a year old. So if you're just getting off the ground, this program was basically designed for you. It's built to help you clear that first critical funding hurdle.
All right, so moving on from government programs, there's another really powerful tool you need to know about: private equipment financing. This is all about getting the essential gear you need to grow your business without having to completely drain your bank account to buy it up front.
So why would you finance instead of just buying it? Oh, the benefits are huge. First, you keep your cash free for the important stuff: payroll, marketing, you name it. You get to use the latest, greatest tech, which keeps you ahead of the competition. Plus, with predictable monthly payments and potential tax write-offs, your budgeting suddenly gets a whole lot easier.
Okay, so once you decide to finance, you hit a fork in the road. And it's a big one. Do you get a loan or do you lease? And trust me, this is not just a minor detail. The path you choose here has major consequences for your cash flow, your balance sheet, and what you'll end up paying in the long run.
Look, each option has its trade-offs, right? A classic loan helps you build equity. You're paying to own it, but you'll probably need a down payment. Leasing keeps your initial costs way down, and it's super flexible, but you don't build any ownership. And of course, buying it outright gives you total control, but man, it ties up a massive chunk of your capital. The trick is figuring out which of these trade-offs works best for your specific business goals.
Let's dig into leasing a little more, because it can get confusing. First, you have what's called a finance lease. Some people call it a capital lease. Honestly, just think of it as a loan wearing a lease's clothing. It's designed for long-term use, and the whole point is that you'll own the equipment when it's all said and done. From an accounting perspective, it actually shows up on your balance sheet as an asset. On the flip side, you've got an operating lease. Now, this is a true rental. You're just paying to use the gear for a specific amount of time, and then you give it back. It stays off your balance sheet, and your payments are just a simple operating expense, like your internet bill. This is perfect for stuff that gets outdated fast, like computers, or for any short-term project you've got.
You know what? Here's the easiest way to think about it. An operating lease is like renting an apartment. You get to use it, you pay your rents, but you're not building any ownership. A finance lease, though, that's like a rent-to-own home. Every single payment you make is building towards you eventually owning it. So the question for your business is simple. Do you want to be a renter or an owner in training?
All right, so we've covered the what and the why, so let's get to the most important part, the how. How do you actually get approved? In this last section, we're going to give you the playbook on how to put together an application that lenders are going to love. This is the inside scoop on what they're really looking for.
The path to getting that funding really boils down to 4 clear steps. Step 1, know exactly what you need and why you need it. Step 2, get your ducks in a row. We're talking business plan, financials, the works. 3, shop around. Don't just go with the first offer. And finally, step 4, submit an application that tells a powerful, convincing story about where your business is headed.
And here it is. This is the secret checklist every underwriter uses. It's called the 5 C's of credit. First is character. That's your credit history. Keep it clean. Next is capacity. Can your cash flow handle the payments even in a bad month? You've got to prove it. Then there's capital. They want to see your own money in the game. It shows you're committed. Fourth is collateral. The equipment itself has to be worth something. And last is conditions. How healthy is your industry? Show them you know your stuff. Nailing these 5 things is the absolute key to getting that yes.
So, there you have it. From government handshakes to strategic leasing, the tools you need to fuel your growth are out there. They're available. The only question left is, which one are you going to use to build your success story? Your business is ready. It's time to get the funding to write its next chapter.